1 by n. 1 by 5 years is equal to 0.20 or 20%. Right? So this is just, they just calculate the rate at 1 by n. Simple. Right? So here, now we can explain the double declining method. So it writes off a larger amount of assets near to the start. So at the start of the years, the depreciation will be highest, right? So it is more aggressive depreciation method, which charges more depreciation at the start of the year. So it is more frequently used depreciation method. We also call this accelerated depreciation method, ADM, accelerated depreciation method. This is DDB, double declining balance method, or ADM, accelerated depreciation method. So what does it mean? Compute annual depreciation by multiplying asset decline book value at the beginning of the year, percentage 2 times the straight line depreciation rate. So straight line depreciation rate is 1 by n. If you multiply with this 2, that becomes double declining balance method. How? Let's do that. So we have given the data here, but here the formula is different. In double declining depreciation method, we do not use depreciable cost, 41,000 minus 1,000. We use rate. How we calculated rate? It is twice the rate of straight line method. So 1 by n multiplied by 2. 1 by, remember which n? The life should be in years, not in terms of units. So this units we will not take into this account. So this is 1.5 multiplied by 2. Answer would be 0.4 or 40%. Now there is a small trick here, because we did not use the depreciable amount here. So how we calculate the value of the yearly expense? Similar, this also tells you yearly expense. So where this, so we know that the double declining rate is 40,000. So where this 16,400 coming from? It is 41,000 multiplied by 0.4. Answer is 16,400. The book value is equal to 41,000 minus 16,400. Answer would be 24,600. Now the value is 24,600. So you multiply 24,600 with the 0.4. Answer would be 9,840. You less with the 24,600, answer would be 14,760. You less it, you multiply this with 4. You see, in early years, the depreciation is highest. Oh, sorry, that is accumulated depreciation. Here, 16,400, and then 9,000, and then 5,000, and then 3,000. Right? Now, do the math here. If you multiply 5,314 multiplied by 40%, answer would be 2,125.6. So we'll just say that round off 6. 2126. So that should be the depreciation. If you see, the depreciation here is 4,314. Why is that? Because last year depreciation is a plug number. Why? Because truck has a salvage value 1,000 and this is the end of the life. We have calculated the book value 1, 2, 3, 4, 5. So fifth value gonna be, book value gonna be salvage value 1,000. So simple. On the last year, we do not calculate, we do not multiply this with 0.4, we just less it. So here 5314 minus 1000, answer gonna be 4314. So small trick here is that in double declining method, the last year depreciation is the plug number of book value minus salvage value. Simple. You understand, Harry, what I just say?
Yeah.
Nam, Marilyn.
Yes, sir.
Ella.
Yes.
Kim. Hunjun Kim.
Yep.
Okay, good. So let's see the what slide says. So double declining method is equal to 1 by n multiplied by 2, which means 20% multiplied by 2 here. So this is 40%. So how this 16,400 coming from? 41,000 multiplied by 40,000 here. So these two columns here. Right? And how much? How we are getting the last year depreciation? It's simple, because the final year depreciation would be 4314, because the book value is 1000. So it's a plug number here. So 5314 minus the book value, answer going to be 4314. Right? So if you compare double declining method, so let's talk about this, the comparison here. So double declining method, first year depreciation is 16,400. Unit of production method, first year depreciation is 8,000. Straight line method, first year depreciation is 8,000. So it means double declining method, the highest depreciation early years is double declining method. Or at the end of the years, in ending years of the life of the asset, the double declining depreciation is lowest. So see, 3542 in forced depreciation, 352, but here 6,000, and in straight line method it is 8,000, straight 8,000. So what we have learned in early years, the depreciation is highest. Which method give you highest depreciation? Early years, double declining method. In end of the years, which method is going to give you lowest depreciation? Double declining method. Right? Let's move forward. So double declining method, it differs from the other method in two ways. Number one, I just told you, the first year depreciation is based on asset full cost. 41,000, not 41,000 minus salvage value, right? So in double declining method, you multiply the full cost price with the double declining rate. And last year, depreciation is a plug number, which is equal to the difference between the book value of previous year minus the salvage value or residual value. So take a picture. I'm also sending this picture to your group. And you have you have 10 minutes to do that. Those who are watching online, so I'm going to be pausing the video here. We will be back online after the breakout room activity. Okay guys, welcome back after the breakout room activity. So let's solve this question together. So a FedEx sorting machine that costs 10,000 with a useful life 5 years and residual value 2,000. It was purchased on January 1st. What is the double declining balance depreciation for each asset? So what is the double declining rate? So 1 by, let me change the pencil here. So it is 1 by 5 multiplied by 2. Answer would be 40%. Right? So let me clear this mess and see the answer here. So that's why here it is 40%. So 40% of 10,000, answer would be 4,000. We have a book value 6,000. So 6,000 is coming here, that is the cost here. Right? So 6,000 multiplied by 4,000, answer would be 2,400. Answer is 3,600. 3,600 multiplied by 40%, answer is 1,440, and we have 2,164. If we multiply this with 40%, answer would be greater than this 160. So remember, our residual value is 2,000. It must not decrease from 2,000. And remember, it means the annual expense is the difference of book value here. So we have 160. So it means we have no depreciation on year 5. So our book value will be 2,000. Right? So there is a small trick here in double declining method. Okay? So I hope you understand. So let's just talk about the comparison. I already told you the straight line method, it distributed the cost based on time evenly, based on the number of years. It spread the cost, depreciable cost on even